Let's move on to this parade of CEOs that we have this morning and talk a bit about Dow. That is Dow Chemical. The share is higher this morning on better than expected quarterly earnings. Dow Inc. really is what it goes by, of course. The company reporting a 27% decline in the fourth quarter operating profit. But the results do point to at least some recovery in demand as global trade tensions ease. Joining us now exclusively is the company's CEO, Jim Fitterling. Always good to have you, Jim.
Thanks, David.
You're welcome. Is this a reflection of sort of an overall rebound a bit in the global economy and demand out there? Or, you know, you still have a ways to go. I don't want to sort of, and I'm sure you'll admit that as well. When I look at all the notes this morning, a slight beat amidst broad declines in commodities, not as bad as feared, and focus on execution and cash generation, still a positive. Give me your take on the quarter and how it should be viewed by your investors.
Well, as I've said before, we've seen strong consumer demand that continues into 2020. Where we saw weakness was in the industrial markets, North America, Western Europe, and China as well. Weakness in big-ticket items like automobiles, carrying over into things like appliances, and also into capital spending. Capital spending in 2019 in those big markets was off as much as half. And so that's really what softened things up on the industrial side. I think now that we've got through the phase one trade deal with China and we've got USMCA done, that'll bring a little bit of confidence back in the markets, but it's going to take some while for that to build up. Most of the weakness that you saw in earnings is based on the supply that's been added. And as you know, we had the big shale gas phenomenon here that we participated in and invested in. And what that's done is helped us reduce our operating costs through this cycle. And in our business, in every trough, you need to be lower cost and better margins. And in every peak, you need to be better than the last peak. And that's what we've been trying to do. And I think that was on display in the fourth quarter. So in addition to beating on the revenue line, the EPS, and the EBITDA line, we had strong free cash flow generation. We generated $1.9 billion of cash. That's up $500 million. A lot of that's because as we spun out from Dow DuPont, we achieved all of our cost separations, and we got to our benchmark best-in-class cost structure. Plus, we pulled $400 million out of working capital, and that's just managing the cycle. That's the business team's doing a great job of managing the cycle.
Right. Now, to the extent that I think you've already noted, though, conditions to date in the first quarter of this year, and obviously we're just getting started, are similar to those of what you saw in the fourth quarter of 19. Does that indicate that there's yet to sort of be a real inflection in earnings that would make a lot of these analyst consensus EBITDA numbers that are higher than at least where you seem to be tracking ones that will be met?
Conceptually, we feel like 2020 has the potential to be slightly better than 2019. Now, GDP rates are being moderated a little bit. We're about a 1.4, 1.5 times GDP company when you look at our product mix. I do think as we're going into the year, we've got three of our chains that are kind of at the bottom of the cycle. We've got the ethylene, polyethylene chain, siloxanes and silicones, and our isocyanates chain, our polyurethanes business. There's exposure on isocyanates into that auto sector and into housing. There's exposure on siloxanes, obviously, into an awful lot of materials. So as we see that confidence pick up and that industrial demand pull, I think you'll see that tick up. The other thing that's happening in ethylene is typically the end of this quarter, there's usually about 8% of capacity offline for turnarounds and maintenance activity. This year, we're expecting that number to be as much as 15%. So we could see, as we go into the quarter, a little bit of tightening in that chain. Not as much capacity coming on as has been historically. So I think you're looking at, if we're not at the bottom, we're hovering around the bottom right now. And with the 6% yield and greater than 10% free cash flow upside in the stock, we feel like there's an equity upside here. It's a good entry point for somebody to get into this sector.
One of the things that I'm concerned about, Jim, is just trying to figure out your cost structure. You've got a lot of debt on for a project that was really built for $110 oil, which is Sadara. And I just kind of try to get my arms around how you can cordon that off, because I figure you get the debt down, then maybe we start seeing buybacks that are more than just covered dilution.
Yeah, so with Sadara, we made some good progress in the year. And you see fourth quarter, the earnings are kind of stable there in Sadara. What we're going to do is we just reached agreement on the final logistics agreement with Sadara. That allows us to achieve project completion, which is a significant step because that's a standalone entity now. And then that allows us to remove the parent guarantees that are on that debt. And Sadara has engaged J.P. Morgan to lead them through a debt reprofiling. And so to give you an example of what that might mean to our shareholders, we put in $500 million last year for our portion of the principal repayment. As we reprofile that debt and get that tenor stretched out and perhaps get some different tables put in place there, that gives us the ability to bring that cash back in, Sadara to be cash self-sufficient, and then we can deploy that $500 million into other uses. Deleveraging will be part of it, and share buybacks could be part of it as well.
Hey, Jim, one question on just regional activity. We were looking for an inflection in growth because of phase one. Now we're worried about dampening effects out of the coronavirus in China. But does that mean that we should look for inflections more in Europe or the United States or somewhere else?
Well, I think the United States and China are really the places that you should look. They're growing the fastest. We saw 7% volume growth in Asia Pacific in the fourth quarter. We were double digits in China, even with the phase one deal and the tariffs that were in place before the phase one deal was reached. Now, a lot of the tariffs are still on, but the demand growth in Asia is still strong. So if Asia demand growth is 5%, we're going to be in the 7 to 7.5% type of growth rates over there. The U.S. is still strong on the consumer, but I think what we're all waiting for is automobiles and the industrial demand to pick up. I haven't seen that yet, and I haven't seen a massive negative impact from the coronavirus yet, but we'll watch that. We've seen some demand pull from coronavirus on things like cleaning materials for disinfectants, like you would use in household cleaners, non-wovens for masks and wipes and those kinds of things. And I think as you see people, stay at home and use more food from the grocery store, you're going to see a pull on packaging as well.
Yeah, that was curious, and that's where I want to end real quickly, Jim. China's tried to reduce their use of certain single-use plastic. Obviously, around the world, that's a continued trend. Are you seeing any weakening there in terms of single-use?
So we sell primarily into higher-end structures, so multi-layer pouches and those kind of things. We're not selling a lot into the T-shirt bags, the grocery bags, straws, or the ag films that they talked about. That is a trend globally. People are trying to deselect and move away from those materials. We're trying to work to continue to get more recycled materials. So an announcement, for example, that was made by Nestle that they're going to buy $2 billion worth of post-consumer recycled material for their packaging line. That's a great announcement because it fits with the work that we're doing to recycle more of our product lines. And we need both that demand pull and also the supply of recycled materials to solve this problem. You're going to see some continued bans. I haven't seen that back up into our demand yet, but we're going to work through that.